The economy honestly feels like it's upside down. Nothing really makes sense and people don't know what to look at when it comes to fundamentals. You have inflation running hot, but you have interest rates at record lows, but then you have debt levels at all-time highs. It is honestly a recipe for disaster for most people. Now I want to talk about the potential of a recession. I'm not naive to the fact that we could completely turn into a bear market here. So we need to prepare. And I want to share with you exactly what I'm looking at when it comes to managing my risk and how I look at still investing in a recession, if we are to go through one. If you are interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, occasionally I will talk about a bear market and the possibility of a recession turn into a depression and the whole world comes collapsing down.
And the truth is, I say this with a smile on my face, but it's actually pretty scary.
Now, despite the fact that there's so much fear, and even this video alone, talking about the title, talking about the thumbnail, and my intro right now, I am very optimistic about the market long term. And that's the key, long term. In the short term, the volatility and what's happening in this market, nobody knows what the next move is. But what we can prepare for is the next 5 years, 10 years, and 15 years. That is how I invest into any markets I look at. If you are interested in having a bit more of a logic mindset when it comes to these markets, then definitely join the Patreon community. I'm talking about stuff every single day, whether it's the economy, NFTs, crypto, and property. Now, it's important to really understand what is a recession, technically, right? Now, a recession is 2 consecutive quarters of negative growth. So if we were to illustrate that with my fancy whiteboard here, which is just my iPad, that would be that this quarter would be negative, then followed by another negative quarter. Now that would be a recession. This is what we already saw in Australia technically in 2020. Now a depression is where we have 4 consecutive quarters of negative growth. This is something we did actually avoid, but I did have feelings that we would go down this path. The only reason we avoided this was that we had the government come in with a huge amount of money, the job seeker, job keeper payments came in, you had holiday repayments paused, and that all meant that we kicked the can down the road till we deal with the lockdowns and the virus, then we come and resume business as usual.
But the fact is, we know business as usual ain't business no more.
So let's just understand holistically where we are at, and this is not just specific to Australia, this is happening across the world. Now, with money supply, we've had money being printed. We've had so much come into the system with the government printing stimulus, quantitative easing, and a bunch of other things. So money supply has actually gone up. Inflation, as a result of that, has also gone up. And this is the opposite of what would have to happen when we cause a recession. So we're going to touch on what's happening.
Because inflation's really high, then how the hell are we talking about a recession? We're going to talk about that.
As a result of these things, we should technically have interest rates go up because we want to contract the economy. What's interest rates done? Pretty much go sideways or even down in some cases. Now we already have some banks coming out and increasing their home loan products and their rates going up. But if you look at the overall trend, it's actually been down for the last 15 years. There's not much to write about. But when you look at journalists coming out and have their pieces of creative writing, then that's a completely different story.
Because interest rates happen to keep going up every single year, apparently.
Now you have money supply going up because the money was created out of thin air. You have inflation through the roof. What's debt levels at? Well, debt levels are at all-time highs and they don't look like they're going to just go away anytime soon. And it's very important to understand this, that when people talk about interest rates, it's the cost of borrowing on the debt. If our debt is at all-time highs and our interest rates are at all-time lows, that's where the issue is, because if interest rates move up too quickly, the whole system implodes. And I've mentioned this in videos before. Now, at the moment, what we have been seeing is the fear, the potential possibility that interest rates will go up. Now, with this in mind, it's caused markets to absolutely lose their mind. We've had cryptocurrency down about 40 to 50% from its all-time highs. You've had stock markets absolutely start tanking, and the property market has held relatively strong. That might be an area for us to continue looking at, and I'm going to share with you what I'm actually looking at. But before that, let's jump into a few graphs that look at long-term historical trends to give us an idea from history what could potentially happen. Now, first up here is the graph of the US markets when it comes to shares. We can see in the little gray highlighted areas is when we've had a collapse, we've had a recession. But what I want to really focus on is the long-term trends here. Now, what I want to focus on is more so the recent 20 to 30 years. You can go through this yourself. It's all online. And then you have a look at here being 2008, which was the global financial crisis. Now, before that, you'd probably see in 2000, it was the dot-com bubble. We want to see what happens to the markets when these things have happened, but then also what happens afterwards. Because say you invested here in 2000, it would actually take you a few years before you even broke even on those investments. This is the entire market. So you could have picked the 1 or 2 stocks that did really well during this time would have went up. And that's where property prices are also the same, and they're going to act in a similar way, which I'll touch on. So if you invested here in 2000, you would actually have to wait probably about 3 to 4 years before you got to break even. Now, as that market continued heating up, then we have the global financial crisis. Now, this one was big. If you see that you invested here in 2007, it would actually take you about 5 to 6 years before you broke even. Again, same sort of rule. If you generalized the entire market, then that's probably how long you're waiting. But if you picked a few stocks that actually did really well during these times, you'd be seeing the opposite. So here you can see again, the V-shaped recovery, although looks very dramatic on here, it actually took a really long time to actually recover. But since the 2008 GFC, we've actually been on a tear. Yes, we've had minor corrections along the way, but the trend has generally been up. If you actually do take a step back and look at this market overall, well, since 1980, the general trend has been up. If you did invest in 1980, or even before that, during 1970s, and we had this massive collapse, if you stayed in the market, you would now be up by more than 10x, which is phenomenal, right? So if you see here, this little gray area was actually the COVID crash. This is where we had the pandemic March 2020 crash across the markets, and we saw a very swift move up. This is because governments came out, they reacted very quickly, money supply went up because they were providing stimulus, but then interest rates got cut as well. So we've seen the general trend has been up, and if there has been a correction in the last sort of 20, 25 years, we've had that V-shaped recovery, although taking a bit of time to come back, the market always did come back. So let's jump to the Australian market, right? So if you look at this and we see, okay, the general trend has been up as well. If you look at 2008, we had that massive sell-off as well, and it looks a bit more dramatic because the market is a bit smaller, but generally over time you've trended back up. Now with shares and stock markets, obviously people investing into ETFs, I personally don't invest into any ETFs, and I'll link a video up here as to why I don't. In this traditional finance world, you can see that if you did buy right up the top in 2007, 2008, it would actually take you more than 10 years to go and make up that money. Now again, if you just purchase at the top and then decided not to purchase again, then yes, you would have to wait 10 years to get that money back. But you often hear people talk about dollar cost average. If you had dollar cost average throughout these years in this market, you would not only have just broken even after 10 years, you'd actually be in a nice handsome profit. Now we have the COVID crash here, which we can see, but since then we've seen all-time highs and we saw it at an exponential rate. Now again, the market having a bit more confidence with how the government reacted could be the catalyst for why this happened. And finally, we move to the Australian property market. Here we can see, since 2004, the general trend has been up. Even if you were to look at something way before this, you would see that it has generally trended up. Now we've had periods of where things have slowed down or consolidated, which is what we saw in 2008. Now the whole world was collapsing in 2008 apparently, but if you come here and you zoom out, you really see that move is so small. In fact, some areas actually grew during this time. This is why there's an issue. When you look at these markets as a generalized version, you find that there's pockets there that have actually grown and others that haven't, and that's the average. So as an investor, your job is to go out there and try and pick the right ones. Now, try is the big word here, because most people are not sophisticated enough to know what the fundamentals are, know how to invest, and how to pick the right areas. And this is why people like the effect of diversity, and so that you can go in, spread your risk, and sort of dollar cost average out, it all works out in the long run. And we can see it with all those graphs, even after these periods of correction. Now, more recently, when we had this sort of drop off here, this was really APRA coming in 2017, 2018, 2019, which if you then overlay with Phil Anderson's 18.6 year cycle, this would be the mid-cycle slowdown. What happens after this is exponential growth. And in this case, we've completely seen exponential growth. And if you're to overlay that with that market cycle, then we are seeing the final phase of this entire market cycle. And that means that we may not see that correction that everyone's thinking we get of 20, 30%. We may not actually get that for another few years. And that is what brings me to what I'm doing. In these markets, you can see historically, the markets go up for a lot longer than you expect, and they go down a lot lower than you actually think they can. So what you've got to do is you've got to trust your investments and your big conviction plays. You can only make big conviction plays if you know what you're doing. You need the right education, need the right mindset to be able to actually execute. The other point to make around COVID and the virus is that it didn't affect everyone in the same way. You had some areas grow, some areas didn't really grow as much, but more from an employment point of view. You had retail businesses basically locked down for about 6 months, had no income coming through, but then you had healthcare workers that couldn't get time off because there was so much demand for it. And so this two-speed economy has caused inequality to a whole nother level. As a result of asset price inflation, we've heard time and time again, recessions and bear markets is where millionaires are made. You see the rich get richer and the poor get poorer. And this is where I would really go and figure out what I can actively do in this market and how do I prepare for the recession. So we know that if rates actually go up, that should mean GDP should go down. So if rates go up this year, we should see that contract the entire economy. But that doesn't mean that all shares and all cryptocurrencies and all property markets actually go down with it. We've seen over the long term, it actually makes more sense to be in the market than out of the market, because generally time in the market has been your friend. So what would I be doing? Well, number one thing is have a strategy. This is so undervalued, having a plan, having a roadmap, and this is why I offer strategy sessions. There's links in the description below. You can definitely check them out if they're not already booked. And the whole idea with this is that if you have a plan and you've logically come up with it, is that when the emotions of the market really kick in, you're not making stupid decisions to sell or buy. And this is what keeps me sane. It's why I can invest in NFTs, invest into crypto, invest into property, and know that things are going to be okay as long as I'm in the market and logically looking at what's around the corner. In addition to that, we realize that dollar cost averaging into this market is a smart thing to do. You may have heard the term, don't catch a falling knife. When the market is tanking, you probably don't want to buy, you want to sit on the sidelines. And that's why I have like a wait and see approach. When we have markets capitulate, yes, sometimes it could be the best buying opportunities ever, but you have rules in place as part of your plan, as part of your strategy, that you may wait for it to have a trend reversal, have the consolidation period, then you can start building positions in this market because you know the foundations are there. The other thing I am definitely doing is stacking some cash. Over the last 2 years, I've had the least amount of cash that I've ever had. Why? Because I've always been investing into the market. Now, with the fear of a potential war on the cards, interest rates apparently aggressively moving up, it means that we can't just be naive and think the market's going to continue moving up. I need to sit back and say, well, if the market does capitulate here, there might be the best buying opportunities ever. So I might have some cash and be stacking away a little bit every month, just so I'm prepared for the crash that if it does come, I can take advantage of. That doesn't mean I'm now saving 100% of what I make. In fact, what I've been doing is probably investing about 100% of what I make. Now I'm pulling it back to maybe 80-20, being 20% saving in cash. The other part to this is having multiple streams of income. This is very undervalued as well. If you lose your job, you go from 100 to 0. That means you can't do anything. There's no investing, there's no savings, and your plan goes out the window. Right now, during these last couple of years, all I've been saying on the channel, have multiple streams of income. Go out there, diversify. If there was a time to change careers, it would probably be now, because you can see what skills you can pick up. This is such a unique time as to where you can take advantage while the rest of the market is uncertain and fearful, especially if they're tuning into Channel 9 News or they're going online
and reading these media headlines that are absolutely absurd.
So for me, it's very important to be in the market rather than out of the market. I know my money is being eaten away by inflation, and we know inflation is a lot higher than what they're actually saying. So if you have enjoyed this video, it took me a bit of time to actually get all my thoughts here so that I could help you guys. But think about this. If the markets like stocks and crypto are risk on assets, they're generally going to go into a risk off strategy. And that's why I have such a large exposure to real estate, because even historically, you can see that when we've had mass panic in the markets, because you can't transact property just like that, it takes time, you're in a position where you're forced not to be able to sell. You can't cash out. It's an illiquid asset. And most people see that as a con. I see that as a pro, because what you can do with your liquid assets is that you can go in, you can trade out, you can have emergency buffers. Whereas the real estate sits as a foundation, it sits in the background, the machine as I like to refer to it, and it sits there and continues accumulating and compounding with growth. Over the long term, I'd rather be in this market than not. If the recession turns into a depression and it's mass panic, then that is the time that these plans come into play. We're able to go in and use the cash that we've been saving to go in, but at the same time, know that there is a possibility that the government will step in again and save us by kicking the can down the road. And that is when you're going to see more exponential growth, and it all plays out with market cycles. So as you know, I'm not a financial advisor. This is my disclaimer that you should not be doing what I'm doing. You can use this as a prompt for your own research as to what you're going to do and execute over the next couple of years. If you're interested in more content like this, definitely subscribe, and I'll catch you guys in the next one. Thanks, guys.